So welcome to the Armchair Trader podcast, and in our latest episode we are returning to the world of ETFs, or exchange traded funds, and this time we have an ETF manager on the program. I know we've discussed ETFs previously, but we thought it would be useful to get someone who's actually responsible for managing an ETF, and to that end we have Austin Graff, who's a portfolio manager with TrueShares in the US. So welcome to the show, Austin.
Thank you. It's good to be here.
So to start off, can you give us a little bit of background on TrueShares itself, the company, and what you guys are up to?
Sure. So TrueShares is an ETF manager that focuses on actively managed thematic and outcome-oriented strategies. TrueShares partners with sub-advisors who have deep expertise and real-world investment experience managing truly active strategies. And they offer these strategies in an ETF structure because it provides investors improved liquidity, tax efficiency, and transparency relative to other structures. And TrueShares is kind of a natural home for the low volatility equity income ETF that I manage, mainly because it's a concentrated, actively managed portfolio.
So for many people, when they think of an ETF, they think of something like, for example, a vanilla exchange traded fund which tracks the FTSE 100 index or the S&P 500, and the whole point of this is it's nice and cheap, it's nice and transparent, and it does what it says on the tin. It just follows the index. Now, in the US particularly, and starting here in Europe as well, we're starting to see the advent of what you've referred to already as the active ETF, as opposed to the passive ETF, which is an ETF following an index. So an active ETF, what we're really talking about here, is something that there is an element of, as you say, portfolio management. Can you quickly just describe the difference there? What's the difference between what you're doing and, say, an iShares S&P 500 tracker is doing?
Yeah, so I think you highlighted it pretty well. The primary difference is the active ETF is more of what I would call a dynamic portfolio, with a manager determining which securities to own and when to buy and sell those securities with the intention of outperforming a benchmark, while the passive ETFs are essentially benchmark vehicles that provide you the return of a benchmark minus a small fee for managing the ETF. But from a structural perspective, they're actually very similar. You get the same tax benefits, you get the same liquidity benefits. In many cases, you get the same transparency benefits. But in the US, there has been some experimenting with semi-transparent ETFs, so they look a little bit more like mutual funds. But to the extent you're not looking at a semi-transparent ETF, you're looking at a fully transparent ETF. You get the same transparency that you would get in a passive ETF with actives.
And with the semi-transparent ETFs, I'm guessing that some of the enthusiasm for that is because some managers don't want the market to see exactly what there is sitting there in the fund, basically.
Exactly. If you're one of the large mutual fund managers, and you're managing tens or if not hundreds of billions of dollars, if you make a move in a trade, you don't necessarily want everyone to know what you're doing, because it might take you multiple days to execute a portfolio change. So many of the larger fund managers that are entering the space, call it a Fidelity, a Capital Group, or a DFA, are looking at both kind of fully transparent or semi-transparent solutions. Often they'll probably be gearing more towards the semi-transparent because they want the flexibility to move around the portfolio without everyone kind of knowing what's going on a daily basis.
And the ETF that you're responsible for, is that fully transparent or semi?
It's fully transparent.
This is actually an ETF that follows a dividend oriented strategy. Can you tell us a little bit about the sort of value add there for investors? And I don't know how familiar you are with the UK investment trust sector over here, but there are some listed investment companies that follow a similar kind of approach where they're investing in the higher yielding stocks because investors like them because of the income. Basically, is that effectively what you're doing here with your fund?
Yeah, there's a couple of kind of elements to break down there. The difference between kind of dividend ETFs and the UK high yield investment trusts are primarily attributed to the structure of the vehicles. ETFs are open-ended vehicles that provide investors with direct exposure to the underlying holdings in the ETF, while the UK investment trusts, at least to the best of my knowledge, are primarily closed-end funds with a fixed number of shares outstanding, meaning when you buy them, you can either purchase them at a premium or a discount to net asset value. So that can create opportunities, but it can also create risk because you're not technically buying a direct portfolio. You're buying something that looks like the portfolio. So that's, I guess, the difference between dividend ETFs and the UK high yield investment trust. But from a dividend ETF perspective, we think it's really interesting in the current environment, primarily just because of where interest rates are right now. So in the US, the S&P 500 dividend yield and um, the 10-year yield are about the same place at about 1.35%. Historically, the dividend yield has been about 2 to 3% lower than the 10-year treasury yield. So from a valuation perspective, if you're just looking at dividend yield, it's really attractive today. But that's kind of the basic high level why people would want to own dividends. There's actually more when you dig under the surface. It's more than just getting kind of an income stream today. It's also the fact that many dividend ETFs also provide dividend growth over time. So if you think about that relative to more of a fixed income security, you could see your income increasing per share throughout time, and then also you get the potential for equity upside. And this is a big deal because historically dividends have played a pretty significant component in equity returns, even in the U.S. I think most people kind of have written dividends off given the last 5 to 10 years of bullish market appreciation. But if you look over the past 30 years, dividends have accounted for over half of the returns of the S&P 500. And then looking back over the past 25 years, if you look for companies that have paid above average dividend yields, they've considerably outperformed the market. So above average dividend payers, so this would be just companies that are paying a higher yield than the S&P 500, which today is a pretty low hurdle at 1.35%. But if you were to own those companies for the last 25 years, you would have generated a return of about 13% a year, compared to the S&P 500 return of about 9.5% per year. So you've picked up about 350 basis points on an annual basis just by owning above average dividend payers. And I think another really interesting comparison is we compare it to the NASDAQ. Given the run of the NASDAQ over the past, call it 5 to 10 years, as we've seen interest rates declining pretty substantially, dividend payers still outperformed over the last 25 years. So it's that 13% of the above average dividend payers compares to about 11.5% return on the NASDAQ over a similar time frame. So when we look back over extended periods of time, dividends have outperformed pretty considerably. Just the last kind of 5 years or so, they've fallen behind a little bit.
I was going to ask you this later on, but actually, from what you were saying, I thought it might be worth introducing this now, and that is the sort of inflation picture in the US and indeed further afield. The there's been lots of speculation about what the Fed's inflation projections versus what is really likely to happen, and I know a lot of investors are worried about the inflation picture. And then, at the same time, as you've already mentioned, yields from government bonds, what cash is paying right now, that's all in the basement. So there is more and more focus on this whole dividend yield picture. Do you think that that is going to represent an opportunity for this kind of strategy that you're running?
Yeah, I think it's a pretty interesting opportunity right now. Historically, higher dividend paying names have tended to be kind of classified as bond-like equities. So if you think about sectors that tend to pay higher yields, they're usually, people think about utilities or consumer staples that fall into that category. And the pandemic associated with COVID created an interesting dynamic in the market that we haven't necessarily seen historically. As the 10-year in early 2020 went from about 1.92% down to about 50 basis points in the first half of 2020, historically the bond-like sectors in the equity market would tend to outperform. And that's not what we saw in the first half of 2020. And that's not what we've seen kind of since the COVID pandemic started. We've actually seen those sectors underperform, and we've seen technology and some of the growth sectors outperform. And I think a lot of people might be sitting here thinking, well, if interest rates go up from here, I would expect many of these bond-like equity sectors to underperform. And we just don't have that view. We believe that since we saw the tech space considerably outperform and we saw some of these more bond-like equity sectors underperform, we think there's a decent potential to generate attractive income from these dividend paying sectors while also getting equity outperformance as interest rates go up. I'm not a macro guy, so I'm not going to sit here and tell you whether I think rates are going to go up tomorrow or next quarter or even next year. But from a risk reward perspective, it does seem like over a 3 to 5 year time frame, it's going to be hard for rates to sit much lower than where they are today over an extended time frame.
You talk a little bit with some of your marketing literature for the fund about absolute dividend yield. Can you explain what that is? How that works in practice?
So absolute yield is just kind of what the yield on the portfolio is today when we think about the absolute dividend. So there's relative dividend and absolute dividend. Relative dividend is kind of saying what's the yield relative to other income options. We feel the yield today at about 3% is extremely attractive relative to other options in the market. We also think on an absolute basis, it's awfully attractive as well, as it provides investors with a decent return on their investment while also potentially receiving upside from capital appreciation over time.
And you are fairly focused on deals in the market at the moment. I know you put out a note, I think it was a few weeks ago, on the Norton LifeLock Avast antivirus system deal. Could you give us some color around some of the US deals that you've seen recently, or that are potentially ongoing that you like from a cash flow perspective?
Yes, so in the US, it's currently a pretty interesting M&A market. One of the deals that you referenced is the Norton LifeLock Avast transaction. We like the transaction mainly because you have two companies that generate really attractive recurring cash flows, and they share that cash flow with investors in the form of a dividend. Both companies were relatively cheap leading into the transaction, which likely allowed for a transaction to happen. But we like the transaction because we think both companies were kind of in a transition from being antivirus software companies to being more cybersecurity focused, and the market may have been missing that. So the antivirus software market is somewhat commoditized, as you have players like Microsoft giving away the software for free. And I think that many market participants saw that and viewed both Avast and LifeLock as having a dying business. But both companies have kind of repositioned themselves as being cybersecurity experts. In Avast side of things, they're more of a global business focused on a freemium market, while on the LifeLock side, you've got a US focused subscription business. When you combine those two together, you get the revenue synergies of marketing your subscription business to freemium customers while also combining R&D departments that are primarily focused on the same thing, trying to stay ahead of cyber criminals. So we think there's a potential to both increase the top line while also saving some money on the bottom line. From a vast perspective, they were spending about 50% of their cost of goods sold on R&D actually. So if you think about the synergies, if LifeLock was spending a similar amount, you should be able to generate a decent amount of savings there while providing a similar, if not better, level of service. Another deal that happened over the summer that we find particularly interesting, mainly because it seems like the market might be viewing it differently, is the AT&T spinoff of Warner Media assets. So this is a reverse Morris trust transaction where AT&T is separating Warner Media assets and then merging with Discovery, which is a media company in the US. And then they're distributing the pro rata shares to AT&T shareholders. This is an interesting transaction because the narrative around the deal has been that AT&T, known as a dividend aristocrat, is cutting their dividend, which is true. They are reducing their dividend, but they're reducing it somewhat pro rata with the amount of operating income that's leaving the company, which should be viewed as a relatively, I would say, beneficial thing for investors. However, you have many headlines out there stating that the dividend drop demonstrates the instability in the business, and therefore it's not something that should be owned. In reality, this transaction allows AT&T to focus on their two main businesses, mainly fiber and 5G, while also paying a relatively attractive dividend north of 4% per share. So we think it provides the opportunity for mid to high single digit growth while also providing a dividend to shareholders so that they can earn while they wait for the story to play out.
We had obviously in both the US and the UK last year there was a lot of companies suspended their dividends, and now we're seeing them coming back now and starting to pay dividends again. In the States, you've still got the sort of and in fact here as well, the COVID is spreading again and the rates picking up. Do you anticipate? I mean, what do you anticipate companies are going to do, presuming that there isn't like another complete lockdown, and that there's going to just be more sort of regional restrictions or tactical restrictions in place? Do you think that the US companies, S&P 500 companies, will be able to sustain the sort of dividends that we were used to in 2018, 2019?
Yeah, I think so. I mean, I think there was just a research piece out of Strategas today that highlighted that S&P 500 companies have 1.9 trillion of cash on their balance sheets today, which is up there with the highest of all time. And so, barring a complete shutdown of global economies, I would expect most companies to be able to maintain their dividends. Now, that doesn't say that kind of the tail of the whip in reopening stocks are going to be able to maintain their dividends. Most of them have already cut their dividends and have not reinstated them because they don't have a stable kind of stream of cash flow coming from them to pay that dividend. But your traditional or your blue chip companies focused on more stable end market should be fine paying out their dividends, especially with the amount of cash on balance sheets today and the ability to borrow with where the interest rate environment is. There's a lot of liquidity out there supporting companies' balance sheets right now, allowing them to essentially allocate capital however they see best. If that's in the form of a dividend, that's great. If they have other growth opportunities, that's great as well.
And from your perspective, you're obviously a professional money manager. When a company there's sort of an anticipation that the company is going to pay dividend X, and you can see that from the last numbers they've got a lot of cash on the balance sheet. What's your reaction when if they pay less than that? I mean, obviously the market reaction is frequently people sell the shares. Is that do you sell the shares? Do you just hang on and if the rest of the company looks solid, you'll hope that they're going to have a better dividend in the next 6 months, or do you actually get in touch with the company directly like some hedge funds do and jump up and down and make a fuss?
Yeah, that's an interesting one. So there's a difference between the dividend kind of process in the UK and many European countries versus the dividend process in the US. In the US, companies tend to announce their annual dividend once a year and then pay it out quarterly. In many European countries, and in the UK, you often see companies announce a one-time dividend or announce that they're paying two dividends a year, which creates some lumpiness in those payments versus what we see in the US. If it's a company that has a lot of cash flow and there's no justification for reducing the dividend, my process would be to get on the phone with the company and try to understand what's going on. I'm not necessarily going to jump up and down and scream at them, try to tell them that they need to run their business differently. There are plenty of companies out there for me to own, and I don't need to be trying to force my views on a company. We tend to be looking for companies that want to pay that distribution and want to grow that distribution over time because they understand that shareholders value it, and they also understand that it holds their feet to the fire on capital allocation. So they're not just trying to grow for the sake of growth or buy back shares at outrageous valuations. They're sharing in some of the earnings potential of the company with shareholders.
And you mentioned earlier that obviously a lot of big US companies are flush with cash at the moment. We're seeing over here like quite a few big private equity firms coming along and buying or trying to buy UK companies. Do you think that there's a sort of similar situation with big companies in the US because they've got these war chests? They're going out there and more likely to be looking for prospects to acquire, and that's what's fueling this M&A activity you've been looking at?
It's hard to kind of pinpoint exactly what's leading to the M&A situation, but I think there are a couple of things that we can zero in on. First, I think it's the liquidity that you just referenced. There are a lot of big companies that have a lot of excess cash. And by the way, if you were to go talk to, JP Morgan or some other bank, they would love to be lending even more to these companies if the companies would take it. And that's just an indication of kind of where the market is today. But two, there's been a lack of consistent economic growth in the economy for the better part of the last 10 years. And so companies are looking beyond their own kind of balance sheets and businesses for sources of growth and sources of, maybe faster growth than what they already have. And then finally, valuations are really interesting because in many cases, larger companies are currently valued at a premium to smaller companies. And actually, there's quite a bit of research out there indicating that the premium of large relative to small is at historic levels. So that divergence in valuations allows a lot of the higher valued large caps to find accretive transactions in small caps just because they have a valuation gap between the two. And then finally, I think your comment on private equity is interesting. We've seen a lot of private equity deals take place in the US, and I think a lot of that has to do with some of the, call it 2010 and 2009 vintage private equity funds that were raised following the financial crisis of '08 and '09 to take advantage of some of the distressed asset pricing. A lot of those funds are actually coming to the point in their life cycle where they need to start returning capital to investors. So to the extent they can take advantage of valuations in the market today, they will, and they'll take the opportunity to essentially return that capital back to their investor base.
Yeah, well, that's some fairly long vintage funds as well, because I mean, some of these guys are only meant to be hanging on to their money for 5 years, and but I know that there was a huge capital raise, as you say, back in 2010, 2011, and a lot of those funds have just been sitting on massive amounts of capital.
I think usually you get like 3 years to invest, 5 years to hold, and then like 2 years to harvest or so.
Hmm.
So that's how I come up with about 10 years.
The one thing I did want to ask you as well is as a manager of an active ETF, obviously the universe of ETFs has been very much on the passive side of the coin, and it's only been recently that we've been seeing more fund managers launching active ETFs. From your perspective, just looking ahead into the future, do you think that, and certainly that is the case in Europe, where we're still the vast amount of 99% of ETFs, he said, coming up with a number off the top of his head, but I'm pretty sure I'm right, are passive ETFs. But we are likely to see more of these coming onto the UK market, onto the European market as well. In the US, do you see the active ETF actually becoming the sort of the senior fund in the end? That although they might be more expensive, in the end, a lot of the mainstream mutual fund managers are going to go with active ETF structures, just because, as you say, in many respects, it's much more tax efficient, and from an investor's perspective, you can buy and sell an ETF like you can a normal share. So there is that convenience factor as well.
Yeah, so I'm not sure that I don't really have a great answer for you on passive versus active ETFs, which is going to become more dominant. I think that there are natural buyers of passive investment vehicles and there are natural buyers of active investment vehicles. I think the real comparison is active ETFs versus active mutual funds. And I think we're definitely in the early stages of a pretty considerable transition from active mutual funds to active ETFs. I think there's been some hesitance of mutual fund managers to make the transition, mainly because they've got such great businesses with sticky capital sitting in their current mutual fund vehicles. But if you were to step back and think about what makes the most sense for clients and what makes the most sense for the market longer term, you would be opening, or the active mutual fund managers would be opening active equity ETFs similar to what we're seeing today. And we expect that to pick up pretty considerably. I think the comparison between active and passive is just difficult because it really comes down to, are active funds going to outperform passive, and what's the market perception of passive investing. I think over the last 20 years, passive has just dominated the capital flows, mainly because people see it as an easier way to invest. So I don't have a great answer for you on active versus passive ETFs. I just think that, we're going to see more transition from mutual funds to ETFs.
Fantastic. Well, thank you very much for that. And just to finish off, your the ETF that you're responsible for managing is the TrueShares low volatility equity income ETF, which I believe has the ticker DIVZ.
That's correct.
Fantastic. And that's listed on NYSE.
Yep, that's right.
Well, thank you very much indeed for coming on the show this afternoon, our time, this morning, your time, to talk about the dividend situation in the US market, and good luck with everything this year.
Thanks, Stuart.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.